What's going on, YouTube family? Welcome to Automotive Life. My name is Lucky, and today we're going to be talking about the downfall of Carvana. Now, their third quarter numbers just came out, and no shocker, everything is down, every single matrix. They are on pace to lose $2 billion this year. I think they're hovering around like $1.5 billion in debt. We're going to talk how a flawed business model, how their cost of servicing debt is slowly bearing them and never going to be profitable, and why I honestly believe that this company was never structured to be profitable or to make money or to be successful. But before I do, if you can do me a huge favor and gently squeeze the like button for YouTube algorithm, and also find more amazing people like yourselves that enjoy automotive content. Also, please consider subscribing. We do post twice a week, so make sure you click the notification bell. And once again, follow us on Instagram at Lucky Lopez, and let's get into the video. If you guys are new to my channel, I'm an automotive expert. I've been in the car business for over 20 years, and we talk all things automotive on this channel, not only from a consumer side, but as well as an automotive business professional side. So when I give you some insight on how Carvana works from the inside and how the banking works, I think you guys be surprised, because from the get-go, we talked on this channel about how Carvana was never going to be profitable, and the simple things they did basically spelt doom from the get-go. Now, we talked about this about a year ago, and I remember we got so much flack because everybody's like, oh, Carvana's the best thing. People hate dealerships. Carvana's going to revolutionize the industry almost like CarMax did. No way. When you're a tech company, I know the whole procedure is to get a lot of money from people, grow as fast as you can, gain that market share, and worry about profitability later. But in the automotive industry, you cannot do that, especially when you have massive carrying costs. Like, I think they have $4 billion in flooring. So their cost of actually doing business and carrying costs are so outrageous, it's ridiculous. So there's no way they can ever become profitable. That's why many of companies have tried to get into this. So I've talked about Amazon Autos. I don't know if you guys knew them. They were actually looking into getting into the car business back in 2015, 16, and 17. They decided it was too much of a headache, and they totally walked away from it. So if Amazon decided it was too much of a headache, why should we think that Carvana somehow had it figured out? Now, we said on this channel, and I don't give out stock advice, when the stock was at $320 something, we said that this company is going to be non-profitable. It's going to be down its way to zero, and people thought we were nuts. Fast forward to today, this stock is trading at $8.32 right now. Just to show you what's happened within 1 year. It blows my mind on how fast things have swung the other way, because people are seeing the cracks in the foundation of what Carvana is doing. We're going to talk about all the business practices and some of the things they did wrong and what's leading them down this path, and why I have no problem saying this right now. I believe within 6 to 8 months, Carvana is going to be bankrupt, or they're going to sell themselves off to somebody. But we're going to first talk about their first purchase, which was supposed to offset their debt. They wanted to figure out a way to become profitable, because usually once you lose a bunch of money, the whole goal of the business plan is to lower your costs and figure out different ways of income. They purchased Adesa from Cars Company. Now, Adesa is a massive, actually it's the second largest auto auction in the United States. When they purchased this auction, their goal was to save $800 average on every single vehicle, because they thought with recon, transportation fees, everything else, they would save even more money. But if we look at the third quarter numbers, they're losing an additional $1,000 of profit on their vehicles already, which I think in the first quarter and second quarter, they were down to $2,700. So now taking another $1,000 off of that, their costs are not going down. Everything is going up. We talked about their cost of money. That's the thing that's going to burden them, because they keep borrowing money from everybody and their grandma at very high interest rates, and now they're working with iaai trying to restructure their floor plan, and floor plans usually work 2, 3, 4, 5 points over prime. So whatever prime is, add those points on there. So let's say, just for fun, they get a great rate at 7 or 8%. I mean, I don't know what 7 to 8% interest monthly on a $4 billion floor plan, but I'm sure it's not very cheap. And that's one of the things that CarMax tried to do. They put all their eggs in one basket and tried to ride the Adesa train into profitability. And since they put all their eggs in one basket, now it's failing. They should protect themselves by being careful and diversifying their investments. That's why I'm so happy that Masterworks is sponsoring this video. It's why wealth managers and savvy investors are investing a sizable portion of their portfolio into alternative investments. This market is fueled by the ultra wealthy. They don't worry about the same microeconomics as we do. When major markets across the world are having major losses, art doesn't always react the same way, because it has very minimal connection to investments like the stock market. In fact, this year the average piece is selling going for 26% more at auction, according to Morgan Stanley. The stock market has lost 30% of its value over the last 2 years, and art houses are reporting record-setting numbers and a larger buyer pool than ever before. The New York Times said it best: when the stock market takes a nosedive, people look to invest in art. So far, they've sold 6 paintings with an average return of 29% to their members, including the sale just last month for a 33.1% return. It's no wonder why Masterworks is seeing more demand than ever. They let you invest in the same contemporary art from legends like Picasso and Banksy for a fraction of the cost. That's why Masterworks is the only platform that I trust for investing in art. So far, they've gotten their investors an average of a 29% net return. So don't be left out. Click the link below and invest in some of the best looking alternative assets ever. Thanks again to Masterworks. So let's go ahead and talk about sales, because sales was what cures all woes when it comes to the car business. Now, they're down 8% this quarter. So not only do they have to deal with that, they're losing an additional $1,000 of profit on every single vehicle. Their carrying costs are going up, their interest rates, their floor plans, everything else, not including the interest rates for auto loans, the softening market with the slowing down economy. And then the worst of all, since the demand is going down, prices are going down, they're losing an average of 1 to 3% per week in value of their $4 billion inventory. So just imagine that. Those numbers are absolutely insane. All these things together basically culminate that there's nothing that Carvana can do to steer the ship right to make it profitable in this short amount of time. I honestly believe that Carvana has about 6 to 8 months left before it basically just goes under. Now, they should have started from the get-go of doing simple things. We talked about business structure. They went out and basically just opened up a bunch of new spaces right away, where I thought they should have partnered up with existing dealer groups, other automotive places that had structured buying centers, had structured service centers, had even structured business licensing departments. Because remember, Carvana's had its license either revoked, suspended, or pulled in multiple states recently. I can't remember, I think it was Illinois was the last one that suspended their license. And some of these states are even talking about permanently doing it because customers have still not received their titles after a year of purchasing their vehicles. They're issuing temporary placards from different states. So me as a dealer, if I were to print out multiple temp tags, I would be shut down ASAP. DMV would show up and take my license away. But why does Carvana get away with it? Well, they're too big to fail. They got a bunch of money, but the tables are turning on Carvana. Not only is the general public starting to hate Carvana, you could see it from the memes and everything else, multiple stories of people driving cars for months, even years, with no registration. The state legislators are starting to hate these guys because they're getting so many complaints. The DMV hates them. And now a lot of the Wall Street people are starting to talk about how bad these guys are doing. They're not making any money. They're basically just full of shit, kicking the can down the road, trying to borrow as much money from anybody as they can with crazy offerings. I think they were, the parent company, which is Drive Time, I know was offering, I think, 13% on some sort of like bond they wanted to get, and they were going to try to back it with like $200 or $300 million worth of auto loans, and nobody touched it. So people even know that even that paper, which is usually pretty strong auto loan paper, is not worth anything. So at this point right now, Carvana has no choice but to start either shrinking, getting rid of their cars, and look about selling out. There's nothing they can do literally to right the ship at this point. So now that we got all the front end operation stuff out of the way, let's go ahead and talk about the back end. We're gonna be talking about buying cars, the servicing of them, and then finance. Now, everybody in my business, the car industry, hates Carvana because they were overpaying for cars so long. So we have a saying in the car business, you make all your money when you buy the car, not when you sell the car, but when you buy the car. So usually as dealers, we're very conservative with our numbers, and we go and we do our due diligence and track everything. But with Carvana on the scene, it basically, they just, whatever number was the closest they can get to high wholesale, they just gave it out. And so people were bringing in these cars, getting absorbent amounts of money. Some people were getting damn near retail for their cars. And so it made more sense for them to just drive over to Carvana and sell it to them. And this disrupted our market completely. Not only did it upset a lot of the franchise stores and independents like myself, but it gave birth to a lot of the new knuckleheads that are out there today. And I'm not even gonna lie, I was one of these companies. I created this one called My Vehicle Value that was purchasing cars online. But my system was completely different. With theirs, you could put in your VIN number, it would give you a quote. You send in a handful of pictures. You show up there, some 18-year-old kid comes out, you hand him the keys, They don't look at your car, they don't start it up, they don't do anything, they just hand you a check and you walk away. It blew my mind. If you go to my channel, I have a video where I literally sold a car to Carvana. I just walked up, gave him the keys, and walked away, and then we filmed to see if he was gonna check it out. I didn't even do that. Where me, if you use mine, I would ask for the VIN, pictures, website, and then I'd make you come down and I would actually go through your car, see what it is, add the damages, the dents, whatever type of wear and tears with the vehicle, and then I would give you an accurate quote. But these guys were doing everything with basically no talent, all algorithm, because it's tech. That was their big push. They want to be the tech company in the car business. You cannot buy cars with technology. I don't care how smart you are. There is no algorithm on earth that can predict how people treat their cars. It's just like housing, like with Zillow. All these companies came out trying to digitally buy houses. And what happened? They got their asses handed to them. They were overpaying for houses, and everything is fine when the market is going up. But what happens when you have a hiccup and the market's going down? So all these companies like Zillow, all these places that are buying houses virtually, all disappeared. Same thing with these cars, companies that were buying cars virtually. You don't see ads anymore. I still run cash for cars and I still buy cars every single day. It's what I do because I actually know what the hell I'm doing. Another thing that Carvana did when it came to buying is they didn't have a lot of QEs, which is qualified employees. When I go to the auction, I see multiple people from multiple places. I see different dealer groups have buyers. I see people like CarMax, they have buyers that buy for them. And so these are educated people that go out and buy cars for these actual companies. Seasoned vets, know the books, know wholesaling, they know what banks work. So companies don't get in trouble when it comes to debt. When I first met my first Carvana buyer, the guy literally was I think a manager at Burger King, left Burger King, joined them. They had a 2-week boot camp on how to buy cars. Basically said buy between wholesale and retail and go for it. And they just set him free with a blank checkbook. I was shocked. So not only had these people that were buying cars at the auction, you had the knuckleheads that were just literally writing checks and showing up and not inspecting the cars. So that's another thing of overbuying inventory literally killed them. Now next we're going to talk about the recon, which is even more hilarious because after you buy these cars, you need to keep your costs low when it comes to reservicing your cars. So the better the inspection you do to lower the price on when you buy it, will help you give that extra money so you don't go over your books when it comes to recon. Sorry guys, that was Carvana calling. They were actually calling to tell me to stop telling the truth. Just kidding. So remember, when you buy your car, the whole purpose of doing the inspection is to lower your actual cost. So this way you have more money for recon so you don't overvalue or overbook your car. And what's happening now is Carvana, they send all their cars out to recon in different places like Pep Boys, other small independent shops. And that was another reason why they technically bought Adesa, is to lower their cost of recon. So now you add the trifecta of they buy their cars, but they're buying them on credit. So now they have carrying costs. They're overpaying for the cars. And then once they get them into the service center, they're like, holy shit, these cars need more work than what we thought. So now the cost is here. So now their profit margin is this much between what they're into it and retail. So this is basically every step that they do is show how they can never make profit. So now they're spending too much on recon. They're buying cars for too much. Next step is the finance department. Well, now we got to finance cars because we got to get something crazy on the back end. So Carvana wanted to get as lower down payments as they can, so this way they can qualify more people for financing. They were selling this dream to all these banks. Hey, we're going to give you millions of dollars of auto loans. Sign up with us, but give us smoking deals and work with us and everything else. Well, that was working great during the booming economy. But now banks are lending less money because the repos are going out of control. They're lowering the LTV so they can manage their risk. Because remember, as banks start having defaults, they need to manage their risk. So they raise interest rates, they make lending restrictions higher, and then they also shorten term and shorten LTV. So all these things are putting a credit crunch on Carvana. So now people are trying to buy these cars. They have to put bigger down payments because remember, Carvana paid way too much to fix them, buy them, and now they're into them for damn near retail or over retail. So these consumers have to put bigger chunks of down payment down. The bank's gonna finance even less of that, and they're gonna charge higher interest rates. So the demand is shrinking every single month. So tie this in with all the other crazy stuff that Carvana is doing, and there is absolutely no way they can steer the ship correctly to make money. I already think I said it twice in this video. I give them 6 to 8 months. Somebody's either going to offer to buy them out, they're going to file bankruptcy, they got to do something because there's nothing they can do as of right now to make money. And nobody's gonna give them money to keep growing their business or anything else because it's a losing bet. Apollo's got that hedge against them where they're basically have adesa's collateral. So, you know, if they file bankruptcy, they're just gonna take that and probably sell it back to the family for pennies on the dollar. But everything that's going on with Carvana, I literally believe it never was made to make money. Anyways, I would love to hear your opinions on this. Please put in the comment section below. Even if your opinion is different from mine, that's okay. We can still be friends. The whole purpose of this channel is to be transparent about the automotive industry, not only helping consumers, but dealerships as well. Hopefully some people at Carvana are watching this. You know, it's not rocket science, but you need to have more QEs, qualified employees. If they would have had more QEs on the buying center, selling center, and especially when it comes to the paperwork, the DMV center, a lot of Carvana's problems could have been avoided a long time ago. They could have did one major push over a 3-month term and probably made some significant changes. But instead of doing that, they're gonna be laying off more people, they're gonna be buying more cars, and they're gonna be expanding their operations, which makes no sense. Right now, they need to shrink. They don't need to grow. They're so worried about everybody outside looking in that instead of focusing on their main business operations. But anyways, I want to thank you guys so much for watching. Once again, follow us on Instagram @LuckyLopez, and we'll see you next video.